In this video, I will walk you through this model for valuing a stock. You start in on the overview page, you click in your ticker. I'm using Walmart, doing Walmart as my example here. Just the ticker. There's several pages to this. There's the actual valuation, which you probably won't start with that. You'll probably start with the discount rate. We'll start with that, but this is your final results. So it's the first sheet in there. So we'll start with the discount rate, and then you have some backup that help either with the discount rate or your assumptions for the valuation. So let's do the discount rate. The discount rate we're using the capital asset pricing model, which says that the discount rate, the cost of capital for equity is the risk-free rate plus beta times the market risk premium. The risk-free rate, we're going to use the 10-year treasury. Here you can see I'm pulling that data from the Bloomberg data pool. So if you go back to the overview, Bloomberg data pool, one of the things I'm pulling from Bloomberg are treasury yields. I'm bringing in the 10-year treasury, 5-year treasury, and then the inflation linked treasury, the TIPS. You'll see this formula here. If you use Bloomberg, you'll recognize it. BDP, Bloomberg data point. For the 10-year treasury government, you want the current yield on that. So I'm bringing that in. I have the TIPS and the 5 years so I can look at the future expected inflation currently priced in the bond market. We may or may not use that number, but 2.3%. So if we go back to the discount rate, we can see we're using the current 10-year treasury. For the market risk premium, I'm pulling that from below, and the way we're doing that is we're using what's called the implied approach, which says figure out the future expected return on stocks and subtract the risk-free rate from that, and that will give you the market risk premium. So the expected return on stocks is the yield on stocks plus expected earnings growth. The yield on stocks has two components, the current dividend yield. Again, I'm pulling that from the Bloomberg sheet. I'm just taking the current dividend yield on the exchange traded fund SPY, which is essentially the Standard & Poor's 500 and an exchange traded fund, and getting the current yield on that. Buyback yield is a very difficult number to calculate. However, I'm using an article written several years ago by Ibbotson and a few other authors where he shows that firms are buying back their stock at a higher rate than they're paying dividends. And so that is a big part of the cash return or the yield return for investors. That I'm just using 1.5% from the article. I have gotten updated information from Bloomberg for the years since that article is written that shows that it still is the case that firms are buying back more of their shares, that yield is still higher than the dividend yield. But it's not a number. I want to just pull the current number because it can fluctuate. It fluctuates a little bit more than the dividend yield. So I'm just using a plugged in number. You'll notice I'm using the conventional of blue for input numbers. So that's the input number. Expected earnings growth, you can see as a formula down here, expected earnings growth. And I'm going to expect that corporate earnings growth will be similar to the US economic growth. Now, where do we get this? You'll notice the next chart, the next sheet is backup charts. I got a chart in here that first supports that the expected return on stocks is the income yield or dividend yield plus expected earnings growth. And for each decade, the red line is that decade's dividend yield plus earnings growth, and the blue line is the actual stock market. I won't get into this too much. I get it into my class, but there is a good indication that over the long term, the stocks will give you the income yield plus expected earnings growth. We're obviously a little bit off of that here recently where the stock market's gotten ahead of that. But you can see historically it has come back down to that line. In my class, I give a few reasons why we might be far off from that, whether it's the stock market's overpriced or there's been some one-time adjustments related to risk and the cost of ownership of stock. But anyway, that's a backup to this particular theory that the expected return on stocks is the income yield plus expected earnings growth. The second chart just shows you that corporate earnings growth in the red has somewhat lagged slightly, not a lot, but has lagged economic growth. Corporate earnings growth over this period of time averaged 6.09%, where the economy grew at 6.41%, but they are comparable. And so we're going to use our expectations for economic growth to be our assumption for corporate earnings growth. I talk in my classes why those two might be different, but they should be similar. They should be somewhat related. Obviously, corporate earnings growth is much more volatile. And then the last one is, if we're going to use economic growth to project the growth of earnings of the stock market, where does economic growth come from? And it comes from three primary places: productivity growth, labor growth, and inflation. I'm leaving import, export out because that's a number that somewhat fluctuates. And here are the components of economic growth in the United States over the long term. The most important one is productivity growth. You can see it was really strong in the 2000s and weak here recently. But again, just support. And so for my discount rate, I'm going to assume productivity growth at 2% because that's been what it has been in the US over the long term. Labor growth 1.5. You could probably go lower on that. It was fairly strong this last decade, but it was actually negative in the 2000s. The average over the long term has been closer to that 1.5. You can see productivity plus labor growth in 3.5 to 4%. And then the last one is inflation. So for inflation, I actually had that in blue, but I could put it in black because for inflation, when I go over to the Bloomberg data pool, I'm actually using the inflation from the forward curve. If you want to learn how to do this, I have a separate video that shows you how to bootstrap the yield curve to get the expected inflation that is in the bond market. But right now, the bond market is expecting inflation of 2.3% over the long run. So I'm using that 2.3%. That's called break even, 5-year forward break even inflation. That gives me expected growth in earnings of 5.8%. If you go back to our historical chart, you'll notice that historical GDP growth has been 6.4 and corporate earnings has been 609. So I'm using a number below history, but that's mainly because it's not that I'm being conservative so much as inflation historically has been above 3% and I'm using 2.3. So that's just the lower inflation is probably the biggest part of that, but you have to come up with your own assumptions, especially on productivity and labor growth. In my classes, I get in a lot more detail on this, so you'll have to watch some of those videos to see what kind of discussion you could have on that, because there's a lot of influencing factors there. And so that gives me a market risk premium of 4.1%. I expect a dividend yield of about 2.6%. I expect earnings growth of 5.8. That means I expect stocks to make 8.43%. I subtract a risk-free rate and I get a market risk premium of 4.1. The next section is, what do you think the beta is going to be? And I have four components here. The first one is revenue sensitivity. What kind of firm is this? Is this a defensive firm or a cyclical firm? So I'm talking about Walmart, definitely a defensive company, a low beta stock. It's a consumer staple. It's a retailer. So, and an especially effective retailer that actually does fairly well in recessions where people cut back in other areas and do more shopping at Walmart. Operating and financial leverage, I have some data over here that show you that. So what kind of firm is Walmart? Operating leverage is how much fixed costs they have in their operations. Financial leverage is how much debt that they have. I won't get too much into that here, but one way I look at operating leverage is how volatile are their net margins. So I'll look at the standard deviation of Walmart's net margin versus the stock market. You can see their earnings are very, very stable. That implies very low operating leverage. And then on the financial leverage, I'll look at Walmart's debt to equity, which is 61%. The market's about 56%. So they're slightly higher than the market on debt, but not much. And so that gives me a beta there. You can see I have three scenarios: a base case, a bull case, and a bear case. The last one, as I use history, for history, you'll notice over here I have a rolling beta. What I do for history is I'll look at their beta over 5-year periods of time, and I like to compare Walmart two key competitors. Here I'm using Costco and Target. This spreadsheet is set up so that you can change these companies. If I want to bring in Amazon, I would just type in Amazon ticker. And you notice here, I'd have to change the date and do some adjustments if I do that. But you look at the period here, Amazon is a higher beta. If I want to do a different company, maybe Home Depot, you can see here, Target and Home Depot are very similar, but one consistent thing you see is that Walmart has a beta that's lower than its competitors that supports that lower beta forecast. And so that's where I'm looking on history. Based on all of that, those four inputs, revenue sensitivity, operating leverage, financial leverage, and history, I get my final beta. So that's what I'm going to use in my valuation. Then I go over the DCF valuation. The first thing I do is I got to look at growth rates. So some of this I'm pulling from Bloomberg. So if you look at the Bloomberg data, I'm bringing in historical data so I can look at actual growth rates. So here's their 3-year, 5-year, and 10-year growth rate for different components of the income statement and of their dividends. So you can see they've been growing really fast recently. Over long term, not as strong because Amazon really hurt them 8, 9, 10 years ago, but they've somewhat come back and really reinvented themselves. So that gives me some data. The second thing I like to look at is what growth rate is priced into the market. I look at their forward PE ratio and their PEG ratio. If you divide their PE ratio by the PEG ratio, you get what does the market think their growth rate will be in earnings per share over the next 5 years. The next thing I like to look at is sustainable growth, which is essentially the return on equity times 1 minus their payout. That has a really high growth rate there. One thing I might do here is adjust this ROE. Here I'm using their ROE, their current ROE, but I might look at that of over 3 or 4 years and maybe normalize it if the last year was unusually high. So there's more analysis you can do here. You can see really radically different numbers, and that's very likely because firms projecting future growth is really difficult to do. The next thing I do is in Bloomberg. If you go on to Bloomberg, if you have access to Bloomberg, obviously this spreadsheet requires you to have access to Bloomberg. You can type Walmart and US equity, then type EE, which is earnings expectations, change it to annual, and you can get these two graphs. One shows forecast for earnings per share. What are the analysts out there expecting earnings growth to be over the next 5 years? And then revenue. So if you go on the Bloomberg, you can get these numbers, you can get the actual growth rates that are priced in by analysts, what analysts are expecting. They also show guidance. Guidance doesn't normally go out much further than the current year, but I'll bring those in so I have that data. And then based on that, it's my assumption. What do I think long-term growth is going to be? What I think short-term growth is going to be? But how many years does it take for them to go from their short-term growth to the long-term growth? That's using the H model. So if you take my class and see the H model, you see how that works. I show it down below. And there's probably typos in here, but I did this pretty quickly. I'll fix it up so if you ask for the spreadsheet, I'll have it all fixed up, especially spelling issues. These are my assumptions, and I typed some here. You wouldn't necessarily have to do that. It'd probably be easier to do that in a Word document to justify. But what are your assumptions for the base case, the bull case, and the bear case? And for Walmart, it's curbside pickup, it's home delivery, it's some of the advertising they're doing, it's expansion in India. They've had some success in India, expansion in Latin America, maybe eventually some expansion into China, although it sounds like Costco is doing a better job there. But those are all your assumptions. You really are. There's no place to go find growth rates. These are your forecasts, your assumptions based on what you think about the firm. I then bring in their current dividend that they paid this last year and free cash flow to equity. I compare these two for Walmart, and for most firms, I will use free cash flow to equity. So for some firms, like a Alphabet or Google, They may not have any dividends. That might be zero. And so free cash flow to equity is all you can use. I pull both of those from Bloomberg. So you're somewhat stuck with Bloomberg's definition of free cash flow to equity. But I pull those on the Bloomberg page. I bring over my discount rates from the discount rate page. And I summarize all of our assumptions down here: base, bull, and bear case discount rates, growth rates, the H factor. Then I use the valuation models, dividend discount model, H model, base, bull, and bear. You can get pretty significantly different answers for a lot of stocks, even much wider than you're seeing here with Walmart. I like to compare that to the current price, the 52-week high and the 52-week low, just to give some sense of how expensive or cheap the stock is. There's a lot of things you can do in here. We highly recommend doing what's called the football chart, but you probably need more valuations in here. And so this is just a start doing DCF. You probably want some relative value models and some other models in here, but it's a good starting point on DCF to give you some valuations compared to the current price and give you some sense whether or not you would put a buy or a sell or a hold on this. Probably on Walmart, I would not put a buy because my base case is pretty low, although the high case looks strong, the bear looks pretty weak. I'm not saying I agree with this valuation because I did it pretty rapidly without thinking too much in detail about the assumptions, but I don't think it's radically off what could be reasonable.